Some people are under the illusion that prices will crash overnight. It hasn't quite happened like that. Although we haven't followed in line with the US 2007 crash, BMO says it's eerily similar to the US path, just stretched out over a longer period of time. And a lot of people didn't believe that at first, but once you start looking at the chart, you start seeing some striking similarities. The shape of the trend, you can say. It's similar, but a lot different in so many ways, and I'm sure you can all agree on that. What some deny to admit, Ontario's not about to correct. It's actually been correcting for 3 straight years. 3 years of sliding prices, 3 years of quiet denial. And now one of Canada's largest banks just confirmed what some homeowners didn't see coming. The bubble didn't pop, it already started deflating. And BMO's Capital Markets just dropped a report that compares Canada's housing market trajectory to the US housing crash of 2007. And their conclusion, although it's next to impossible to recreate the conditions that fueled this boom, there are many differences, but there are many similarities. And in this can give us some clues of what's to come. I'm Linda, one of the Ragona sisters, and around here we talk about current events that actually matter. So make sure to like, share, and subscribe because I'm breaking down exactly what BMO said and why they think that there will be an ongoing dip of prices and how you can use this information to help you make smarter, more confident moves in this crazy market we live in. So prices in Ontario have been falling since early 2022. That's 3 full years of decline. And according to BMO, that's exactly what a deflating bubble looks like. It's not a dramatic pop, but it's a slow leak. So check out this chart. The peak price in the GTA hit about 1.35 million back in February of 2022. Fast forward to September 2025, and that same average is sitting around 1.06 million. That's a drop of roughly 21%. Looks less like an abrupt crash and more like a steady deflation, doesn't it? And this is exactly what BMO meant when they said Canadian real estate bubble isn't about to pop. It's already been deflating for years. And when you look at the slope, you realize this correction isn't just quicksand. It's more like gravity. So what is BMO's actual message here? Let's get to the point. BMO's senior economist didn't hold back. While many are searching for bubbles in the equity markets, he said, one continues to undo itself as we speak, and that's the Canadian real estate market. He also reminded readers that bubbles are only obvious in hindsight. And what we're seeing today in Ontario is eerily similar to 2 moments in history, the US post-2007 housing crash and Ontario's early 1990s collapse. Both were textbook bubbles. So this report weighed heavily on the fact that this is a classic bubble. And because of this, I decided to look at what an economist textbook definition of a bubble really is. They describe it as 5 predictable stages. And honestly, if you look back at what happened in our market, it's almost like aligns perfectly. So stage 1 is displacement. Something new or exciting changes the landscape, like ultra low interest rates, record immigration, or pandemic migration. That's what literally kicked off the buying frenzy in 2020 and 2021. Then you have stage 2, it's the boom. Prices start rising, media attention builds, and suddenly every dinner conversation is about bidding wars and price jumps and how much you made on your real estate. Stage 3 is euphoria. This is when logic completely leaves the room. People believe prices can only go up from here. You see FOMO, fear of missing out, bidding wars, 25 offers on a regular, nothing special, semi-detached, and buyers saying, if I don't get in now, I'll never own anything. Then there's stage 4, profit taking. The smart money, they're leaving. You see investors selling at the top, listings start to sit a little longer. And then there's whispers that maybe, just maybe, the market's cooling. But most people ignore it. Then there's stage 5, pure panic, or what economists call the bust. Reality hits, prices start dropping, demand evaporates, and confidence collapses. Everyone suddenly realizes prices were completely detached from fundamentals, things like income, rents, and real affordability. And that's the textbook pattern. And if you overlay our data, it's hard to deny the fact that we've been through this or going through these stages since 2022. So what is actually BMO saying other than the fact that we have a similar shape? Good question, because on the surface, sure, the graph looks similar to the US housing crash in 2007. But BMO isn't just talking about a visual pattern here, guys. They're talking about the underlying behavior, the sequence of events and market psychology that created both bubbles. The run-up looked almost the same. Both markets saw a surge in home prices that completely outran incomes and rents. In Ontario between 2020 and 2022, prices rose over 50% in less than 2 years. Absolutely ridiculous. Almost identical to the pace of US run up from 2004 to 2006. That's the kind of acceleration simply doesn't happen without speculation and leverage. The fuel behind the boom. Both booms were fueled by cheap, easy money, and in the US, it was subprime lending and teaser rate mortgages. In Canada, it was ultra low rates and overconfidence, buyers stretching debt to income ratios because money was free. Different mechanics, same psychology. And then the speculation mindset. In both cases, people started buying homes for profit, not for living. And that's the key BMO points out. When a home becomes a trading vehicle, you've crossed from housing into speculation, pre-construction flipping, bidding wars, and blind offers. It's the emotional driver that pushed the US bubble into euphoria. And lastly, the rebalancing process. Both markets are correcting from the same reasons: to restore affordability, to align prices with incomes, to reset investor expectations. That's the rhyme BMO keeps referring to. Not a carbon copy, but a similar economic rhythm. This is exactly what's playing out. So when BMO says Canada's market resembles the US housing market crash, they're not saying it's exactly the same. They're saying the psychology, the overvaluation, and the drawn out reset, those are the similarities. And the most important line from this report, BMO says, the cycle will be measured in years, not months or quarters. So let that one sink in. Years, not months. In other words, it's a cycle, it's a slow process where the market has to work off years of overpricing and get back to in sync with incomes, rents, and real affordability. This is what a bubble looks like after the peak: slow erosion, cautious buyers, longer days on the market, and reluctant sellers. Now let's get real. The US crash of 2007 was brutal, it was painful, and it was fueled by bad loans and financial engineering. Canada's situation is completely different. Our lending standards are tighter, conservative, and our banks aren't overloaded with junk mortgages. And if this price dropping pattern holds, it could take 2 to 3 years for Ontario to regain their footing on pricing, according to the report. Who wants 2022 prices anyways? Many want 2025 opportunity with 2030 vision. Because when everyone's staring at the rearview mirror, the smart money is already looking 5 years ahead, and that's a fact. And that's the real story here. Do I agree with BMO's report? Not entirely. I think there are a lot of major differences. They're right that prices are still unwinding. I see that every week when I look at the data. They're right that it will be a long cycle, because it's already been a long cycle so far. It's a slow normalization, a market digesting its own excess. We don't have subprime loans. We don't have mass defaults. They have risen, but they're not excessive at this point. We have real people adjusting to real math. We have higher rates than we did in 2022. We have more conservative budgets and a new normal for affordability. And just to wrap this up, I think this report is more of a reality check. Now the question is, what do you do with it? But the better question is, how do you play the cycle? The story doesn't end with 21% price drop. Because what's happening right now in the GTA isn't just about charts or cycles, it's about fundamentals. And those fundamentals, things like rising inventory, higher borrowing costs, tighter credit, is what continues to create the environment of downward pressure on prices. It's economics. So in my next video, I'm actually breaking down the key fundamentals driving the slowdown. Because understanding those forces is how you stop reacting to headlines and start making smart, grounded decisions. And it could actually help you answer the simple question a lot of people ask: have we reached the bottom yet? And if you're watching this thinking I need a clear plan and you want to chat about the Greater Toronto Area, we would love to hear from you. Because smart real estate isn't about chasing peaks, it's about positioning yourself before the next wave starts rising again. Thank you for watching this episode, and we'll see you in the next one.